top-down analysis is like ruining lives. It is destroying careers. It is wrecking families. Bottom-up analysis is bottoms-up analysis. Am I right? Because like it is just a stock picker's like haven right now.
Welcome back, ladies and gentlemen, to another episode of Trade Risk Live. I'm your host, Evan Medeiros, and I am joined by the returning champion, Aaron Jackson from the Rotation Report. Give a hello to the people there, Aaron.
What's going on, folks?
And it's a special roundtable edition. For his first time joining us is Mr. Tommy Lackey. He is a CMT, CFP. He's got a lot of other impressive acronyms after his name. He's an RIA, and he does a lot of cool stuff with market data. And so, Tommy, thanks for joining us. How you doing today?
Doing great. How about you guys? Appreciate y'all having me.
Doing great.
Good. We're doing good here. We're excited to have a grown-up in the room. You know, me and Aaron, sometimes we just get off on these tangents, and you know, we gotta be kind of kept in line here. So we're lucky to have you, and we're going to jump right into it. And I think Aaron is going to kick things off with us today with a little bit of a chart here. So let's move up this momentum chart you have here. And Aaron, tell us what we're looking at.
Yeah, so that's a really interesting look here. We've got momentum exposure and hedge funds, massive record tilt in their portfolio. And you go through the momentum stocks. You've got the AI, you've got the GLP-1s, but then you've got a lot of things that you can't really poke fundamental holes in. But you still just wonder, like, wait a minute, how is this going to play out? How is this going to unwind? And I think we're seeing that right now. Tommy, do you have any thoughts?
Yeah, I'm not sure if we're seeing the unwind right now yet. I think we're starting to see it spread some. I mean, this is really a scenario to where profit taking can go a long way, which I'll talk about here in a little while. But when you look at this, I mean, the first thing I notice is look at what it says: weight in leaders minus weight in laggards. Well, of course, because the leaders have been the absolute largest stocks there are. So you buy a few shares, you're getting some pretty decent weight in some of these areas. And you're in a scenario to, again, when you're talking about hedge funds and larger players like that, they have been migrating towards large caps for quite a while now. This is not really a new fashion scenario. Now, your point's valid as far as once we get to certain weightings, how far can it go? Well, I mean, that it really is a question, because I was always told never to say too high. So it kind of gets into a running issue as to how exactly you want to try to manipulate that.
You know, the one thing that's interesting, so let me share my chart here, and then I want to get your thoughts on it. I was looking at the Mag 7 stocks, right? So we've got these 7 culprits here, and let's just go down this list real quick. And this is a monthly chart, everybody. So we're looking at each bar representing a full month of trading. But what's quite interesting here is that when we look at the Mag 7 stock, Tesla, for instance, right, I think it's the worst performing. It's in about a 50% drawdown from its 2021 highs. If we look at Apple, since 2021, I mean, it's kind of flat, right? It's just kind of meandering here. It's more or less flat over the last 2 years. We look at Google, right? Google is flat to down over the last 2 years, and I'm sort of cherry picking 2 year because that was the previous high. Meta, I think, is where you start to get some more gains. Of course, you're up 25% from 2021 highs. Nvidia, of course, this is the elephant in the room that's totally dominating, has, you know, incredibly left behind 2021 highs and is up 140+%. Microsoft, also impressive, up about 20%. Amazon, down. So you have this interesting thing where you have technically 4 of the 7 Mag 7s stocks are flat to down versus 2021. Tommy, I'll kick it to you. I mean, is that surprising, or is it different? Does it you know, when I look at something like that, to me, it's almost like, well, geez, maybe we do still have more room up on some of these things. Like, what are your thoughts when you see
No, I think you're exactly right. And that's why we end up pulling back and looking at wider view charts when we're going through our charts. That's the exact importance of those to see where we're actually coming from and kind of what we're getting into. Now, would it surprise me looking at your Amazon chart right there? Would it surprise me for us to move sideways for 4 to 6 months and frustrate everybody? No. But that's kind of what I was mentioning earlier is that, these guys taking profits or things like that, profits in some of these large caps, because off those lows, it has moved a lot. And it's a great, strong move from there, or if you just look from the November lows. So either way, this is not a bad profit-taking spot. Have we really seen it yet there? No. Am I thinking that's what's going to happen? I don't know yet. Right now, that candle is not saying pullback. And
Correct.
so it's just a matter of seeing where the chart develops out. But one thing I think I want everybody to step back and look at just from a different magnitude. Everybody talks about this whole idea of, the Mag 7 are, 120% of the S&P returns for the year, or the NASDAQ returns for the year, or whatever. And, they say they have all the returns plus and all this. Those, again, are just statistical manipulations. If you really looked at it, you've got those guys that are really killing it. And then you've got 10 or 20% on the other end of it that are just getting smashed every single day. But you've got a lot of 10 or 20% in the middle that are also still doing pretty darn well. They just don't have a lot of market cap. They don't have a lot of weight in some of these areas. So everybody wants to look at it that way, that these guys are 40% of the NASDAQ 100 or S&P or whatever, and that's all fine. But let's take that from the S&P. These 7, I can't remember what the number is, but isn't it something like 30%?
Yeah, I think that's
35% right. Of the S&P now. Okay, let's just use 35%. If we were to take and have a 10% correction, meaning 10% profits taken out of that space, and it brings it down to a 31% weighting. That money goes somewhere. Do you realize that currently is the entire weighting of the energy sector in the S&P 500? So just profit taking for 10% could double the energy sector if that's where the money flowed to.
That is wild.
So I think that's something we don't take enough account for, is that yes, I care to some extent. And yes, the average stock does follow the major indices and does follow the markets. But as we get stretched more and more and more in weightings, the less that tends to happen. The more you can have an average stock actually working differently and an average sector working differently than the overall broad indices because of these kind of weightings. So if technology was 20% or 17%, about like it used to be, that's a different thing because you got 2 or 3 other sectors that are right there with it. With the stretch we have now, I'm not sure that everything's going to move with the markets, because I believe that everyone believes that we are in an upswing now with interest rates coming down eventually, which we'll talk about in a few. And if that is the case, then money is likely to rotate as opposed to leave.
I think we're seeing it. I mean, I think the evidence is just starting to pop up everywhere. And if you take a little bit of money out of these, I mean, you look at a GE or something like that, or some of these consumer stocks that have just straight mooned for absolutely correct reasons. But now you take some out of your winners and then you add a little bit to these other better opportunities that have set up nicely. I mean, I'm guessing that's probably how this rotation kind of plays out.
Well, and I think you're right. It's about what we are seeing. And that's why we are seeing, and it's been a month or so now that we've started to see small caps, but not really a month. Honestly, small caps are still outperforming from the beginning of the October-November rally. Okay. They just ran really fast and stalled and have done nothing but move roughly sideways. And so from the beginning of the rally, they still have a slight outperformance. And so if we do move out from here, the spread out I think we've probably seen during this sideways move is something that can benefit us. Now, again, we're looking at IWM, which is also one that's kind of a little more. I use it in my website right now too, but I've started looking more at IJR to move to the S&P 600. It's not that much different. It's a very similar kind of setup, but it does have different weightings, a little better weighting setup than IWM has. In this situation, it's not going to make a big difference for us. But yes, that's my feeling is that actually your mega caps have led since COVID or before. Since before COVID, really, and led by a lot since then. If you look at some of these comparative charts of IWM and SPY or those kind of things. So even if it spreads out, that's my point, is it doesn't mean the major indexes have to go into major downturns. It just means that if they start stalling or slowing down, you could very well see that money move somewhere else, because the secondary part of this is that interest rate picture. And that would be very logical for money to start moving into smaller and mid-sized companies if we feel the liquidity situation is going to ease up. So
no, that's a perfect place to go, I think, right now with the rates. Do you have a chart for that, Evan? Yeah, I got it. If you want to share my screen a little bit. We got the whole longer end of the rate curve, the 5-year yield, the 10-year yield, the 30-year yield. You can see the 10 and 30-year U.S. Treasury yield. They're testing those October 22 highs right now after we had that massive fake breakout in, was it Q3 last year? So, I mean, you want to talk about an interesting spot for rates. I mean, here we are.
Yeah. It's interesting that, I think, Tommy, back to what you said maybe a few minutes ago, like when we think about Mag 7 market cap weighted stuff, doesn't have to necessarily correct or go into some doomsday bear market. Even if it slogs sideways and we get some internal rotation that coincides with perhaps these rates coming down, smaller caps starting to take a little bit of a leg up here, I think is kind of actually very interesting. So you do a lot on this, Tommy. So you have a chart to share on some of the market breadth and internals and some of the way you're tracking some of these movements underneath the market hood?
Let me get onto this page that you're on. I'm pulled down a little bit. And from the breadth standpoint, I would expand it here, but if I expand it, it's going to be the entire page. And so that'll be a little bit big with the monitor that I have. But with this breadth situation right here, I run a lot of major breadth indicators on one chart. Now, I run them all against an equal weight universe that I put together. It's rather large. It's a little over 3,000 stocks. It takes anything over 50,000 average 30-day volume and over $100 million market cap and over $5 per share. So those are my three criteria. If it's in those three criteria, it hits this equal weight index. Now, again, this is not an equal weight index to follow and look back what's happened 5 years ago versus what's happened today, because mine rebalances every single day. So if you fall out of that criteria, it drops out. And that's why what you'll look at on the website is everything is done in percentages. So that way I can still keep true to what's happening in each new day's action while still having the index components change. Excuse me. So that's one thing just to look at with mine. However, I take those 3,000 and I look at the breadth on them. Here is the universe. I call it the power universe. And this is all of them. This is what the breadth picture looks like. The top one is the new high, new low differential. So this is just basically the number of 52-week new highs in any day minus the 52-week new lows. And then you put the 10-day moving average and a 30-day moving average. 10 days the red and the 30-day is the blue on that. That's a Justin Mammoth, basically Signal. Also Chris Peruna,
legend
on Twitter. He's the one I learned a lot of this from back in the day on how to follow larger trends, longer term trends with this breadth indicator. It's pretty bullish right now. It's got a lot of buy in it. And honestly, like I had mentioned earlier, is that, breadth is fine in this because we know the markets as a whole have kind of pulled sideways during this move. And we know that in that, from an index standpoint, when we look at my equal weight down here, they're moving pretty well sideways. So the fact that we haven't seen breadth really leak down or deteriorate is a good sign. Anytime you have a thrusting type situation like we did at the end of the year, if digestion can be sideways, you can't really ask for much more. And that's what we've seen. So our longer term indicators on here are this new high, new low indicator, the advanced decline line below it, which is right at the highs, and the percent above the 200-day moving average, which is this red one that my cursor is right by now. All of them are in pretty high levels right now, not screaming, not to where I'd be worried about overbought, but they're definitely up there. And then all of my shorter term are all improving pretty well. McClellan summation index, the breadth thrust, and the percent above the 20-day moving averages are all improving, with the McClellan summation turning up with a new fresh buy signal here. Now, again, that's across the whole markets. And this is what I've been watching while I've been sitting here listening to everyone tell me about how bad breadth was getting. It's not. And it's pretty normal, again, after you have a thrust like we had. Of course, everything's going to scream up above the 20-day moving average. And then a bunch of them are going to pull back below it. But as long as they stay above that 200-day moving average, I'm cool. Again, that's where as trends start to shift and change, you've got to make sure you're changing your mental picture of what's going on with it.
I love that. Yeah, I love that you're saying this, because I feel like I'm crazy sometimes when I read, some peers, some market professionals out there that are saying, breadth is bad, or breadth is recently over the last couple of weeks, and I'm scratching my head. And look, breadth, as you know, and you're pointing out here, breadth you can analyze in lots of different measures and metrics and look back periods, right? So everybody has sort of their own, piece of the data that they'll want to cling on to. But I think fairly objectively across 52-week highs and those ratios like you're showing here, it's sort of the strongest breadth environment I think we've seen since the 2021 timeframe.
Yes, that's absolutely right. And that's the other side of it is, again, if you were expecting it to stay at the peak levels it was in December, after we came off those thrusting lows and almost a failed breakdown in some of these areas, you don't understand how breadth works.
Right.
That's just not how it works. We'll see it expand again if we break out again right here. That's Correct. How it works. It doesn't always lead. You just don't want major deterioration. Now, like yesterday in one of my charts, I did see, and I did notice that, yesterday, not today, but yesterday, because all my stuff is as of end of the day data, on this chart on the right, you'll see that we did not, even though the day was slightly up, we did not have higher 10-day highs, higher 21-day highs, or higher percentage of 63-day highs. But again, that's one day. Right. It's a noisy indicator. Those are why you have to watch these things on a regular basis and make sure you get a good idea of how they work and how they move. But there really is nothing in this market right here that tells me anything other than if Aaron is right and money is finally moving out of these largest players, which I do think we've seen some, it's not leaving.
Right.
It's just moving to other spaces, and the two different types of rotation. You can have sector rotation. You can also have size rotation. Mm-hmm. And we're kind of seeing a little bit of both. It doesn't even have to leave technology if it just moves its way down the ladder. That's what we started seeing in semiconductors. Yeah. Is that now that some of the bigger semiconductors are starting to stall, you see some of the small and mid cap ones start to really pick up. Doesn't mean they're getting all that money, but they're certainly seeing some more breakouts there. I think SWKS was one that looks like it's on the verge of a longer term one. Obviously, MU just jumped out in the last few days after a good sideways pullback / type move and things like that. And so it's just really short-sighted to think you're going to get – because, see, the thrust we saw off that November low was true institutional money. And institutional money doesn't come off the sidelines for 2 weeks.
That's right.
So at this point, they want to know where to put it. They're not looking to take it away.
Yeah. You talk about the Skyworks. Definitely, just there's so many sub industries in that the semis are exposed to. You can definitely see the different setups they're just churning along in the different groups, whether it's like memory or some of the smartphone stuff. Yeah,
while we're talking, let me take us there, because that's one of those things on here that you're exactly right. So many sub-industries that come into it. That's one of the main reasons I did what I did here. Again, I promise you guys, I did not come on here to be an advertisement, so I'm happy to just move other things. But that's the reason I split things up the way I did. That's the reason I call semiconductors a subsector and not an industry, is because I bring in a lot of these other related industries, because the S&P industry groups, some of them are 5 stocks, and that's useless when you're doing the kind of breadth work and things like that I do. So I took the time to go and put them all together, and I formed 51 subsectors that takes in a lot of those small guys and puts it in the bigger spot. So now with mine, when you pull down to the bottom and look at the relative strength ranking list, you've got pretty much everything in the semiconductor space is right here. I don't have to spread it out by industry group or that kind of stuff. And so you're right. There's so many different places in there you can move around. And, right now you're starting to see some things. I think ASML, if I'm correct, is starting to wake back up, or it was some option work in there after getting hit recently. And so, there's a lot of stuff in this particular space still. And actually, let's look back up top. This is something I'm actually going to cover this week. Let's look at this chart. Okay. If we look at this RSI chart, it's got decent relative strength. If you look at my relative strength rankings, which are up at the top, it's got decent relative strength up here, but it's not screaming up all the way. But look at this chart formation here. Mm-hmm. It doesn't look at all like SMH.
Right.
No.
That looks like a sector that's setting up to me. You have two, almost like a double bottom that comes up. You know what that is? That's a WA. So you get a breakout over here. You've got a nice WA formation. Boom. And so again, that's the whole equal weight sector. So even if S&P does pull back, we have a lot of potential. I mean, not S&P, SMH does pull back. There's a lot of potential here as far as this overall sector still.
Great point. I love it because everybody is fixated on the two ETFs, SMH or maybe SOX, and they look so parabolic and make them equal weighted.
XSD. XSD is actually the equal weight semiconductors. Again, it still doesn't look quite like this because it's only like 40 or 50 of them, but look at that.
Yeah. Much different, much different versus.
I mean, if that moved over those highs, if XSD moved over those highs, would you not love that chart?
Beautiful chart, right? Nice consolidation.
Tightening up right here at the end. Nice tight handle right there.
Yep. Boom. Beautiful. Yep.
And while we're talking semis, let's pop my screen back up and talk about NVIDIA. We're not poo-pooing NVIDIA at all. The SMH definitely stretched, but that earnings, man, it popped a big level. And SMH, like a lot of people are mad about this NVIDIA move. Whew, they are mad. But it might roll over and, get back below, say, 730. But I mean again, it's just,
If you're weighing your stock by the PE ratio, you're years behind.
True that.
Yeah, I mean, this is what stock pickers should like, though. This type of environment we're moving into now, right? I mean, this is where you kind of separate and find some of these things like an AMBA or some of these smaller biotech or anything. This is where the opportunity and some of the fast movers come. This is the part of the cycle that I personally like the most that this seems like we're rotating to.
Well, this is the big transition here. Evan, do you want to tell them our bet? We can go into the bet just briefly.
Yeah, I mean, I can't say I'm not going to enjoy, reliving this moment, but a few weeks ago, Tommy, Aaron and I were sort of talking about the Russell 2000, and this was back on, I don't have the date. I should have the date.
Couple weeks.
A few weeks ago.
We were into a panic.
Oh, it was right after this. I think it was this day, actually. It was right. Isn't this right when we got hammered?
Yeah.
I think it was this session here. And I made the case. We made a bet basically of the next 7% move in the Russell 2000. And I took the side of the over, the up, basically saying, was it 215? I don't have the numbers in front of me, but we basically placed a bet of what happens first, IWM 215 or IWM 180 or 175 or whatever the exact 7% move to the downside was. And Aaron made the case to the downside. I made the case to the upside. Jury's still out. Full disclosure, right? Like anything can happen here. Nobody's won. But this breath, this, the strength underneath the hood continues to solidify here. And so
here's why I brought it up. I brought it up because he was making his case based on stocks he was finding, the bottom up analysis. And my case was based on, look at the range and the IWM. There was a little bit of a false move there. The top down technicals. Top down analysis is like ruining lives. It is destroying careers. It is wrecking families. Bottom up analysis is bottoms up analysis. Am I right? Because it is just a stock picker's haven right now.
I mean, when we think about other sectors, we talk about biotech, but we haven't actually looked at any charts. I mean, I can look up at XBI at a big move today, heavy volume coming in as this really starts to accelerate. IBB, similar thing. We're getting a nice kind of
look at
consolidation.
that. Oh my God. That
Perfect,
is
right?
beautiful.
Big long base, right? Big range, big break of multi-year highs now at this point. Do you have anything? How are you looking at biotech specifically? Do you have different indices? I mean, you're looking at obviously some equal weight breadth. What has that been showing you on your side, Tommy? I'll pull your screen up here.
In biotechnology, from a breadth standpoint, again, this is what I did in my video earlier, and then I never posted it. Basically, if you look at biotech, one of the most important things here is that if you look at this versus the XPI chart, the IBB chart you just showed, as I mentioned earlier, it never really turned sideways. It pulled back for a week or two in the beginning of the year, a little volatility, but since then it's been climbing since basically January 19th. All right. So it did not follow the same as some of these other ETFs. So that kept me kind of in the range. In fact, January 28th right here is the last time I profiled it in one of my writings, was basically the weekend here, saying that it looked like it was not going to be correcting much more because it had held up so well. But when you pull it down to its breadth, same thing. As I mentioned, the breadth does take a little bit of a dip here. And as you can see, as we get down to the shorter term breadth measures, they kind of took a fast run down, even without price moving much. But look how quickly these shorter term ones came back and are now above the flat lines or above the 50-60% ranges. And your percent above the 200-day moving average never really reacted. Your advanced decline line never really reacted. Your new high, new low differential never really turned negative. And so that right there gives you an idea that there is continued rotation within this sector, even if the largest names aren't there. Then you look down here, and you're looking at our relative comparative chart, which basically does comparatives versus our equal weight universe is the top window. Next is versus our equal weight healthcare index. The next one's versus the SPY, then versus the QQQ, then versus the IWM. It's very rare that you have any equal weight index outperform all of these with this type of trajectory. I mean, that's just pretty crazy how strong that's moved. Again, beautiful. All levels, all sizes, and all of the other constituents in its own sector space.
So is this exactly what you'd want to see when we're ending a 10-year little, what you want to call it, sideways, whatever?
Well, that's exactly
it's gone nowhere for 10 years. I mean,
depending
that
on
looks
what you're looking at,
go.
And my stuff goes back for quite a while. But depending on what you're looking at right here, I go back to the 2021 area that I mentioned earlier. If you expand this to the whole window, which I'm not going to do because it's going to whack everything out, you can go back quite a bit further. But in looking at that's exactly right. But if nothing else, it's been an underperformer for probably 5 or 6 years since the last nice little run it had. But it hasn't had any extensive outperformance, you're right, in almost a decade. Now, let me go to this last chart right here just to show you how it acted during the quote unquote sideways or pullback. Is that pretty much this is, again, remember, this is the 10-day highs, 21-day highs, and 63-day highs and lows, percentage-wise of the sector. So 20% of them are still making 10-day highs, 15%, 21-day highs, 10%, 63-day highs. And again, if you zoom out and look at this chart, we haven't seen action like this since right off of the lows in the middle of 22. Okay. But look how strong it stayed. That's the difference.
That is.
It kind of ran up and then moved sideways. Look how robust this has stayed. And that's, again, shows you that it's rotating from one name to another.
I mean, we covered a lot. We covered a lot of sectors. I don't know if you have individual names you want to talk about.
Do we have, what's the seasonality? I don't have anything on seasonality.
That's what I was going to talk about. That was basically, everybody's really big right now on the seasonality, and us need to have a pullback between now and March, which there's two ways to look at that. Number one, it wouldn't surprise me if the larger indexes did pull back because of these mega cap weightings pulling on them, but us not really see under the surface or equal weight take much of a hit. And then number two, The other thing you've got to look at is this seasonality should have started a week and a half or so ago, and we've done nothing but move sideways so far. So that's the second point. If we do not get a pullback when we're supposed to, then you've got some level. And I think Callum Thomas put out a thing this week about seasonality in bullish years, which they defined by a year that closed up, versus bearish years, or years that closed down. And the difference in trajectory is much different.
Very interesting conversation about, like, people are bringing up a lot, like the seasonality thing. It's like, right, we don't want to really dig into like every zig and zag on a seasonal chart. We just want to catch the, the key points within the bigger picture. It's kind of interesting that people are like obsessing, like, oh my God, stocks are up, so now seasonality.
Again, it's I swear to you guys, it's the fact that they're looking for something.
Yeah.
I mean, they are grasping at every pot. I'm not saying we won't pull back. That's just part of what we do. But they are grasping, and that's part of the reason I'm not sure we will, is they are grasping so hard at every straw, like seasonality, they can possibly find as the end of days. That just tells me that there's a lot of underinvested people.
Yeah.
That's a great point. I mean, heck, even I have a nice little list of things, a checklist, because things are going up. They're going up rapidly now. And you're like, okay, what's going on here? We got to make sure, we got to watch our backs. It's like, okay, well, maybe rates break up, or maybe oil breaks through 80 and starts to catch up. Like, stocks that are going up are really going up. So if that happens to, say, the energy space, okay, maybe that affects the earnings of a lot of companies. But, we're all doing that right now. You nailed it.
We're all speculating, but again, to me, it's a matter of where we move to.
Yeah.
I think you're a fool if you think that this is going to be an end situation for now. I just think we're too much down that path of, for lack of a better way to put it, a Fed cycle.
Yep.
I'm not expecting 8. This is where I think where we are right now is so many people were looking and building it up to 8 cuts this year, which was silly and stupid, that all we are now is back to the 3 or 4 that reasonable people thought in the first place. It just might be a couple months later than we thought it would start.
Yeah,
totally. Yeah. I think Aaron made that point a couple weeks ago when we talked, but basically about the Fed expectations and the reset that we're now seeing here, 8 starting the year. Now we're at 4 or 5 or wherever we are now, is just a much healthier, logical place to be, I think. To the point though about, I think this kind of illustrates things, is the VIX here. And obviously it's not a perfect measure by any stretch, but I had, it shows this jump, this spike, this knee-jerk reaction to want to panic that we got on that 1 or 2 day sell-off. And, maybe we could say the VIX has no business being under 13. Maybe it's too complacent. Okay, that's fine. But we still got a very quick spike, almost up to 18 in this 2 day, blip here for the SPY. And I know there were some things going on, but right in here, this is 1 day causing, a lot of people to want to look for that excuse. Like you're kind of saying there, Tommy, a lot of people looking to hedge up or just, get nervous or wait for the big fall to come. And when everybody's in that mentality, it's tough to manifest when everybody's got 1 foot out the door.
Yeah. And I think that's something I heard someone say the other day about that. And I love, that's one of my favorite phrases, the whole 1 foot out the door. And I think that's the best kind of market to be in. People know they need to be involved, but they're still scared. And that's really the key here when it comes to the VIX and things like that. I think what you pointed out was that spike was exactly what needed to be shown. Actually, I'm not big on technical analysis on the VIX, but I do put Bollinger Bands on my VIX. And what I see is when it spikes outside the top Bollinger Band, if it does not stay there or does not start expanding those bands quickly, then chances are it's just kind of a one-off, So I kind of look at it from that stance. And then on the second scenario is that I really don't consider the VIX being very important until it gets over the 20 level. It's all noise until you break over 20. Once you break over 20, you have a different environment that money managers have a more difficult time holding larger amounts of equities because of the potential daily volatility. And so that's a different animal once you get over 20. And that's usually when when worse things start. So you mentioned spiking up to 18, even up to 18, while not fun, doesn't really start any big flags for me at that point.
Yeah.
Well, that's interesting. So you think it's kind of, is there like a round number element to VIX is what you're saying?
No, I'm just saying 20 or higher. No, it's because of what
for like catching people's attention. Yeah, 20 over 20. It's like whoa versus the
it's more of the equation. It
Okay.
now becomes the amount of volatility you're going to get in a single day. Once you're over that potential volatility, just makes it more of a deterrent for people to get involved.
I got you.
What else? Anything else on the agenda, folks?
Bitcoin. Got to talk a little crypto. Just briefly. Man, Bitcoin did not even dip.
No, it's it's quite impressive. I mean, I've really been beating this drum here a lot on this trade, but I had a couple of thoughts. So one is, well, let's show some data. So I mean, we've seen
Eric, oh my God, you should see Evan's fundamentals on the Bitcoin. It's fantastic.
No, I mean, so Eric Belchunas, I believe, is how to pronounce his name. Sorry if I'm butchering it, Eric, but he's been really kind of shining a light on the flows that we've been seeing come into the new Bitcoin ETFs over the past almost 2 months now, and the volume. Yesterday, I think this was over $1 billion in just iShares Bitcoin product alone. And we're seeing just an absolute, give me as much as possible here in terms of flows, in terms of activity. We're looking at essentially raw flows into these ETFs, and they are really, with the heavyweights here in the top 10, top 15 of volume traded and just the positive flows. This thesis, this Bitcoin trade that I've sort of been obnoxiously talking about is really driven by what we're seeing here. I mean, I think it was just a pent-up demand, and love Bitcoin or hate it. You don't have to have an opinion on whether it's going to save the world or not. I mean, just from a trading vehicle and a flows perspective, I think this is what you had to really sort of latch onto as an idea on why Bitcoin could start to work here. I mean, we talked about this a couple of weeks ago, looking like there's a magnet to kind of retest and get back up towards those old 69 highs or 68K or wherever it was. So I wanted to talk about, just a potential opportunity on this video, which was going to be just this nice, tight, beautiful, coiled range of a trade setup that we had. And that was what I was excited to talk about. But that train sort of left the station over the last 2 days, where we got this volatility expansion. We got this breakout, and we continue to essentially be locked out of this trade. You have to chase it at this point. So look, lots of risks. It's not going to be smooth sailing. There's going to be a lot of volatility and obstacles in the way. But for now, I still think the flows are a big catalyst here for the next 6 months, let's call it. I mean, they're going to dry out, but it feels like, there's certainly enough interest here shown in this first 30 days. All right, gentlemen. Well, this was fun. We covered a lot of ground. Let's see what else. I think that's everything. We're going to have links in the description, everyone, to find Tommy's website, to find Aaron's research, to sign up and take a look at everything that they're doing, along with where to follow them on social. So with that, I want to say thanks for tuning in to another episode of Trade Risk Live. And gentlemen, thanks so much for joining.
Thanks for having me.
It was a pleasure.